Let's start with SPACs. It's a hot market, and in this very hot market, you raised the largest SPAC in the market right now, and it seemed you had hoped to have an announcement of a merger target by the first quarter, but that didn't happen. What are the challenges you're facing?
So I would say I'm cautious about, what we don't want people doing is speculating, buying short-dated options on our SPAC. So I'm a little bit cautious about talking about it. But I would say I feel very good about Pershing Square Tontine Holdings. Our original construct was to create the most investor-friendly and the most merger-friendly entity, and to create something that was unique. Fundamentally, capital is a commodity, but capital at scale in a large blank check company is not a commodity, and that's been our experience. And I would say I'm cautiously optimistic I'll have something people are excited about within a reasonable period of time.
Can you just explain
I don't want to give a precise look. When I made a comment, I think in November or so, November or December, I said my expectation was we should be in a position to identify a target and announce the transaction by the end of the first quarter. That was my estimate.
Mm-hmm. And what happened? Is it partly because asset prices are going up so much? Has that been part of the challenge?
No. I would say I'll give you a little more information. We've been working on a transaction since early November. Same transaction, a lot of complexity, and I think we're either going to get a transaction done in the next relative short term, weeks, or we'll be on to the next one. But obviously, it was sufficiently attractive and interesting. It was worth devoting 6 months of our energy to.
Do you think it will involve other investors, like other big institutional investors? Is that part of the complexity?
No.
Okay, just Pershing.
There are big institutional investors in our SPAC, but just the nature of the target, the issues we're solving for them principally have made the timing longer than we would like. But we think it's worth the energy and the effort.
That makes sense. I mean, I just did a little research myself. I pulled up the list of the most valuable VC-backed companies in the U.S. because you're looking for, as you've said it, a mature unicorn, a minority investment, and you have about at least $5 billion to work with.
Actually, that's one of a number of categories that we're looking at. So mature unicorn, we certainly talked about. It's gotten a lot of media attention. We've also talked about, super high quality, durable growth companies. They could be private family-owned businesses. They could be controlled by leveraged buyouts. They could be carve-outs from corporations. Any of the above.
Okay, well, I pulled up another list from Forbes, America's largest private companies, and I just did my own looking at some of these. I figured some of these wouldn't be right for you, like PricewaterhouseCoopers and that kind of thing. But there was Publix supermarkets and H-E-B supermarkets, and you're a food guy, right? You know that industry well.
Yeah, I'm not in love with the supermarket business.
Oh, yeah? Is this commoditized or what?
Is business that you could own for the next decade and the stock market could shut and you'd have enormous confidence the business would be worth multiples of the price you paid today. That's kind of the company we're looking for. If you think about the supermarket business, I think there's a lot of disruption going on right now. It's a low margin business. I don't think of it as particularly attractive from a growth perspective. So it really doesn't meet our criteria.
Another one on this list that I thought might match your history was Mars. So you've had a lot of in packaged foods.
Sure. So again, if we're going to go down a list of targets and just eliminate one by one so you figure out the name, I can't do that. But
okay.
The good news is we're deeply engaged in a transaction that we started working on in early November with an iconic, phenomenal, great business with a great management team that meets all of our criteria. And there's a lot of complexity. There are issues that we're solving. Our goal is to solve the problems of a seller or someone who wants to take their business public and do it in a way that we provide a really great solution for them.
And it's still looking as you would be a minority holder. Does that hold firm?
Yes. Okay. When I say minority holder, the business will become a public company.
Right.
Shareholders will own a minority of the company. That's correct. But again, to be very, very clear, there's no certainty this transaction happens until we sign an agreement.
Right. Well, there are a lot of people I've read, literally support groups online, like hanging hopefully on this one. So I'm sure they'll look forward to news.
Yes, as I say, I'm cautiously optimistic, but there's no certainty, and an issue could arise that could prevent us from getting it done. My judgment, I mean, the fact that we're focused on one transaction for a long period of time and we haven't wavered, if you will, suggests that we are reasonably confident we're going to get it done, but there's no certainty.
Okay. And then that's not the only thing that you might be announcing soon, right? You sold off Starbucks recently
Yes.
and alluded to that. You have another big investment that might be disclosed within maybe days.
Well, I could do it right here if you'd like. I know
That would be great.
Journal likes announcements. So we sold Starbucks, which is really an amazing business, largely because it got to a price that was hard to earn the kind of excess returns we like to earn over time. Kevin Johnson's done an amazing job. The team's done an amazing job. It's really a great business. But the stock just recovered too quickly, too fast. And I think investors will do well with Starbucks. But for a very brief moment, another restaurant company that we followed very closely over a long period of time dropped dramatically in price for reasons we didn't understand. And we were able to swap Starbucks for Domino's Pizza.
Oh, okay. Well, that's been
we didn't get as much as we would like, but we own a little under 6% of the company.
okay. And that's been a standout in the pandemic, right? I mean, can you talk a little bit about what else you've liked about Domino's?
So one, obviously, we like the restaurant industry. Interestingly, we've never lost money in investing in a restaurant company. I think we've never not made a lot of money.
And just to remind people, you own Burger King's holding company and also Chipotle.
Yeah, so it's a space and industry we know and we like. Domino's is a pure franchising company, and interestingly, they were really first and best in sort of technology and delivery, and they own their own delivery infrastructure, so they don't need to rely on the DoorDashes and Uber Eats of the world, and that is actually an important competitive advantage in a world where you can deliver pizza for $7.99. It's hard to do that with a delivery service taking massive cut of the proceeds. So it's an extremely well-run company. They've done an incredible job on everything about the way they run their business, to the way they grow their business, and to the way they allocate capital in their business. So it's real standout. We've admired it for years, and it was always never cheap enough. And then for about 5 minutes, it got cheap. I don't know who sold or why, but we started buying around 330 a share, and then it very quickly moved up a lot.
They've done a lot of interesting things with technology, even ahead of the pandemic, right? In terms of streamlining the process and.
Yes. And it's actually a great, if you will, it's a great ESG story. If, a lot of the franchisees today started out as drivers, so there's a real path to, grow in the company and become a franchisee, own multiple units, and the returns to franchisees on stores are extremely high. And you can become a millionaire, a 10 millionaire, starting out as a driver for Domino's. So it's a very compelling story. And there's a big international growth opportunity, which they've pursued, and there's still plenty of room to run, both here and abroad. So,
and talking about those drivers who can grow in the company, I mean, getting workers is an increasing problem for restaurants. And can you speak a little bit about what you think about this debate about the unemployment benefits versus as a factor here or not? Like, what do you think needs to change or not?
Yeah, the surprise numbers that came out, I guess, last week are not due to any weakness in the economy. The economy is crushing it. Okay, businesses are, booming. I would say, think about hospitality. You can't get a reservation at a restaurant in New York anymore,
except 5:30 or 10, right?
Right, and that's with excess capacity now that the restaurants are open. I think we're almost fully open indoors, and plus all the outdoor space. So I think restaurants are going to have a boom year, and the result is that so there's huge demand for labor. I think there's the largest. I think yesterday there was a number of the largest gap between job listings and the people who need. I mean, the point is there are plenty of jobs. People haven't had to work, partially because of the stimulus. I think that has made it somewhat. I think when unemployment benefits step back and some of the stimulus wears off, there will be more of a supply of labor.
But should that happen more quickly than September, in your view?
I think that's a tough one. What I'll say is I think a good thing is wages are going up. I think that is obviously good for the worker and also good for the economy because, workers are going to spend the money. Chipotle announced recently they're, basically an average wage of $15 across the country.
But can you tell us a little bit more about that decision? I mean, it does cut into profits, right? And so how did that calculus go down?
Obviously not my decision, management's decision, but I think it was a pretty easy one. So first of all, Chipotle generally pays more than other kind of fast food restaurants. Two, they've got a great product at a great value where they do have pricing power. And so they're able to offset the incremental costs of paying higher wages with, charging a little bit more for a burrito, right? You charge 50, 60, 70 cents more for a burrito. You can pay your workers more. It's still very, very good value to the consumer. So the key in a world where there's going to be inflation and there's going to be wage inflation is to have a business that sells a product where there's pricing power.
Inflation is the topic of the day this morning with big numbers, surprisingly high numbers out, even when expectations for a high number. Can we go to this question, a video question from one of our viewers here, Harry Kane?
Well, hi, my name is Harry Kane, and my question is, as we're get into an era full of the inflation risk. So what's your suggestion for us to improve our portfolio to deal with this inflation risk? Thank you so much.
Sure. So I do agree. I think there's going to be inflation. I mean, you don't say there's going to be, there is inflation. It's happening. There's wage.
Is that a debate between like business people who are experiencing rising prices and addressing it versus economists who are saying, oh, this is just temporary blips coming out of the pandemic? I mean, where do you come down on that?
Yeah, I think it's not temporary. First of all, it's hard to roll back wages once you roll them up. I mean, they go from 15 to 12. So I would say we have a new baseline in terms of wages, sort of generally. You look at every commodity price, right? New copper, lumber, make your list. Look at what's going on in energy even before the colonial, pipeline issue. Look at housing prices. Look at Bitcoin, right? Everything is inflating, and that's driven by. We have a kind of a once in a moment in history. Right, you have people emerging from a pandemic with the animal spirits that come from being locked in their homes, right? So that's dramatic. You have all of that hit. The vaccine rollout is actually in the U.S. certainly it's been fantastic. So you have a lot of people feeling being fully vaccinated, going back to their lives, and then you have the Trump stimulus, the Biden stimulus, infrastructure, an extremely accommodative Federal Reserve. And everything concentrated in a couple of quarters. So that
the Federal Reserve too accommodative, do you think?
I think they're going to have to raise rates for sure. And I think, they adjusted their policy, in my view, just at the wrong time. A preemptive policy toward inflation, I think, is a better approach, particularly in a world where we have, massive stimulus, economic stimulus.
Is it too much stimulus? I mean,
I think with rates where they are, there's a very good risk of the economy overheating, which is why I think rates go up. And really the answer to the question that your viewer asked is you want to own businesses that have pricing power, and you want to own businesses where the value of the business is not going to change dramatically if rates go up. And so, the risk to markets is, what's interesting is if you build a discounted cash flow analysis of a company and the business generates no profits for a decade and then, grows very rapidly thereafter, a huge percentage of the value of the business is in, if you will, the residual value of the company, in your little DCF calculation. Small changes in the discount rate you use have a very big effect on the value of that kind of a company. And so that's where the kind of high flying, highly valued technology companies that are not generating much in the way of earnings today, those are, I would say, the biggest risk with respect to rates rising. And you want to own businesses that can, raise prices to make up for their incremental input costs, whether that's labor or lumber.
Okay, thanks. So, and you're also exposed to the housing market, which, as you're saying, that's also seeming on fire. I mean, what's your outlook there for the housing?
I think we've gotten to a point where the millennials can afford to buy a home. We do have very, very low interest rates. And I think people, after being stuck in a small apartment, the notion of actually having your own space and having a lawn, it's become a lot more appealing. And I think you're seeing that in housing. We own a company called Howard Hughes Corporation that owns these sort of small cities. We call them master planned communities. And we've seen enormous, the company just announced earnings yesterday, dramatic increases in everything from condo sales in Hawaii to lot sales. And even the New York City real estate market is starting to boom again, which is interesting.
But the Howard Hughes, are they focused more on the South and West? And is that part of your bet there? I mean, I know you've owned them for a long time, but you invested more, right?
Yeah. So we first of all, the largest assets are in Texas and Las Vegas, and then Hawaii, and then Maryland to a certain extent. And Hawaii is not a low tax environment, but it's in a world in which it sees the day. Life is too short. It's a destination and a place where people.
YOLO.
A lot of California technology people who just moved to Hawaii and said, "Look, I'm not moving back, and I can run my company virtually." So I think the fact that you can run businesses virtually, places like Hawaii are going to be more appealing, even though taxes are not low. And then you have, Las Vegas or Nevada generally, and Summerlin, where are kind of the best real estate in Las Vegas. And you can have a great quality of life and pay no state taxes, which is a huge advantage.
And what about Pershing Square? Are you all headed to Florida like some of your rivals, or?
I think we're going to be the last standing taxpayers in New York City. No, we hope not. Look, I think New York's an extremely desirable place to live. It is a big tax burden. And when people, high income people do the math and they say, well, I can move to Florida and buy this amazing house and not pay state taxes, it motivates some people. But my whole, when I was younger, I planned to be successful. And when you're successful, one of the benefits of being successful is you can choose where you live. So to run away from a location because the tax rate is higher seems kind of silly to me.
Well, but not everyone is in that position, right? And so, like, in terms of people making these calculuses, might face a little bit more of a difficult calculus.
Sure.
What do you see as the long-term future of New York City? Are you concerned that the calculus is just starting to change for too many people?
Yes. And unfortunately, you lose a few super high income earners, and that has a very, very negative impact. And so I think tax policy has to be set in such a manner that it maximizes revenues, as opposed to tax policy shouldn't penalize one class of people versus another. What it should do is maximize the pie, for the benefit of, maximize the revenue pie. And I think, what I think New York is learning is it takes, a few, Wall Street hedge fund folks to move to Florida. Stories yesterday about Millennium and others, setting up Florida or even Puerto Rican, Puerto Rico locales. We don't want to lose too many of those. We don't want to lose their income.
Yeah.
Their taxes. Look, I think it's very, very important who the next mayor of New York is, and that we actually have a pro-business mayor. The mayor of Miami's done a great job recruiting technology executives. The next mayor of New York has to do the same thing.
Are you involved? Are you backing anybody in particular?
So, Ray McGuire is someone I've gotten to know, and I think is a super high quality, great leader, and I think he'd be a great mayor. And Andrew Yang, I also have gotten to know a bit. I think is also a terrific candidate. I want New York to have a great mayor. Those two will be in my ranked choice, voting list. And I think it really matters who the next mayor is. And I think SALT tax deductions matter as well. And I know that's going to be important.
Okay, we'll see how that plays out. Coming back to Domino's, it sounds like you're just very happy to be a long investor there, and it's not like the contentious guns blazing Bill Ackman we've seen in some situations in the past. And have you had an activist campaign?
I have no recollection of guns blazing in the past.
Well, we talked about ADP a few years ago. I mean,
there were no guns blazing other than the part of the CEO of the company.
But are you sort of moving away from some of the more contentious battles that were more of the flagship of your earlier years?
So I would say the press made it the flagship of our earlier years. What I would say is,
don't blame the media.
The fact that
Teddy Roosevelt elections for board seats, trying to win.
The fact that we ran proxy contests and won proxy contests and made management changes in the past enables us to be a great, constructive, thoughtful shareholder going forward, and it really makes it. I think the likelihood of our running another proxy contest is extremely low and we've been able to find amazing businesses with great management teams. And even in the case of Chipotle, we had a visionary founder who built that company. I mean, that was an activist investment. People don't remember that, but 4 or so years ago, stock was in $265 a share when we worked with the board to recruit Brian Niccol to be CEO of the company. And the founder, Steve Ells, was as supportive of that decision as we were. And so
isn't part of the benefit of activism an element of corporate accountability, and that if management doesn't welcome you in, that's not going to hold you back if you think the company could be better run for shareholders? And if more and more of you are stepping back from that role, does that take something of value out of today's business community?
So I think what's changed is that boards of directors understand their responsibilities. That's number one. And number two, people know who we are. And they know that we say, look, this is not right. A change needs to be made. And, I think the outcome of that is we don't have to have big battles. Chipotle, I think, recognized the position they were in. We were offered the opportunity to put 2 directors on the board. We worked to recruit 2 other directors. 4 of 8 directors were replaced. And it didn't generate a lot of press in the Wall Street Journal. I guess it's a negative for the media.
I think we did cover it, but as a short seller, I mean, you're not going to be. You've said you don't want to be short selling anymore, and Andrew left had a similar reaction after what happened to his position with GameStop, and short sellers are another form of accountability in the market that is sort of in retreat. And do you see that as a concern as well?
I would say the only time we ever really had guns blazing was a short position. I would say that's an accurate description. And I pointed out as it's the most ESG investment we ever made in terms of what we accomplished for, poor Latinos who got a $200 million settlement, or the settlement ultimately with the FTC, the SEC.
You're talking about Herbalife
Farm Practices. We did a lot of good, but we lost a lot of money, and it's just not something. We're going to rely on the government to enforce those rules or other short sellers. It's just not a business we have any interest in.
So in terms of businesses you do have interest in, I have a question here from Wayne Anderman, who says, how does an investment idea percolate to the front of your mind? What does a decision-making process look like? And is it finalized by a consensus at Pershing Square, you personally, or how does it work? Can you give us a little insight into that?
Domino's is a good example. I mean, so over the last 18 years, we've followed a meaningfully large number of companies, and we're looking for businesses. I call them simple, predictable, free cash flow generative, dominant, super durable growth companies, and we track them. And what happened in the case of Domino's is it's a business we followed over time, and then for whatever reason, the stock dropped significantly. A couple of members of the team kind of pulled out the file, dug in, updated our numbers, updated our model. Looked into, thought about the change, perhaps the change in dynamics with, I think that the bear case on Domino's, I guess over the last couple of months, is that they were a beneficiary of COVID, and now no one's going to order pizza.
Well, they're going out to restaurants, they're not ordering pizza, right? As you said.
And I think and also that there's more competition, right? with delivery for any restaurant today, there's, you can order things other than pizza. And ultimately, our view was actually a lot of negative during the COVID environment. There weren't, football games where you invited over 12 of your buddies and ordered in Domino's. It wasn't a lot of college campuses. in session ordering in dominoes. And, our view is, there will be continued growth in that business. But that was kind of an assessment we did. But typically it's in this case, a 2-member part of the team updated their kind of research on the company, presented to the rest of the team. We discussed the idea, and it was a consensus decision because we were all in favor of it. But, we like having a balance between, 2 people do a huge amount of the work. I'll read, 10Ks, conference call transcripts, get updated on the story, but won't talk to, let's say, industry experts. And then other members of the team who are not actually involved in doing work on the idea, but all of us have the same economic incentive. We all own an interest in the profits of the firm, and we're big investors in the funds that we manage.
So once the stock dropped, how long was it? Like, was it just a few days or a few weeks, or how quickly did you move at that point?
Pretty quickly. It took us probably 10 to 15 days to kind of, our approach is to put together a pretty detailed kind of PowerPoint presentation to the team. In this case, we didn't focus on dotting I's and crossing T's. It was just plain obvious that we should start buying. But about 10 days for us to update our work, I would say. And it wasn't fast enough because we did miss out on.
You missed a little, yeah.
Yeah.
So the market's been moving. So we have another question from Matthew Frisch, and I'm sure it's on the minds of a lot of people. Your thoughts on crypto? Sure.
So I think crypto is a fascinating phenomenon. I think it's a brilliant technology. I kick myself for not understanding it's one of the best speculations ever. I should have been there, Bitcoin $100 or whatever. But it's not a place where I would feel comfortable personally putting any meaningful amount of assets, and therefore I wouldn't invest, our firm's assets
because
there's no intrinsic value, right? That doesn't mean intrinsic value to me is driven by cash generation. You have to be able to build a discounted cash flow calculation.
So you're not a gold guy either.
No, never been gold. So, sort of for the same reasons, I sort of admire and respect the creators of these instruments. I would be concerned about if a friend had a lot of their net worth invested in one or more cryptocurrencies, I'd want them to take some money and put it into something a little more durable.
Even as you might be just a little bit jealous.
I'm not a jealous person.
That's nice.
But I'd be happy for them. They made a
little bit happy for them. Okay.
Go buy a house. Go buy something.
Take a little off the table.
Turn some into cash. Exactly.
Okay. We have one more minute left, and I just want to ask, besides looking at dominoes and your SPAC, is there a CEO that you feel you've just been really impressed with during the pandemic, might be a little unsung, that you just feel has done a great job?
There are a number of them. Look, I think Marvin Ellison at Lowe's has done an incredible job.
That's in your portfolio, right?
Yes. And, Lowe's was kind of a mess when he got there. The systems were a disaster. The technology was a disaster. The website was a disaster. And, he very, very quickly got the company sort of up and running, fixing these problems. And they weren't 100% done when the pandemic hit, and then sales took off. And it's hard to make those kind of changes while the plane's flying.
Right.
It's harder when the plane's flying, 30% faster than it's ever flown. And so he's done an incredible job. I think Chris Nassetta at Hilton, right? If you think about a business.
Also in your portfolio.
Yeah. That decimated, by the pandemic, just kind of braced under pressure, setting up the company to succeed to an even greater extent. Chipotle.
Right. And hopefully there'll be more travel, but I'm going over our time and I could talk on and on, but thank you so much for being here, Bill. It's been so fascinating. And I'm sure I want to thank our audience and WSJ and elsewhere. So wish we could continue, but we've got to move on. Thank you so much.
Thank you so much. Appreciate you.